Hello, everybody. Welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thanks for joining us this week. Today, we thought we'd talk a little bit about the reflation trade, what's going on with interest rates, and how diversification continues to work and benefit you, our clients. So it really feels like the reflation trade, the economy, the expectations for the economy to heat up in the later part of this year is happening on Wall Street. We're seeing different parts of the market that trade higher when we see reflation have certainly moved significantly higher, namely the small cap arena. But before we talk about that, if you look at what's happening in the bond market, we're seeing interest rates move up pretty substantially over the last few weeks. We're at almost 1.3% on the 10-year, which is an absolute low in real terms, but we were at 50 basis points not so long ago. So that's a really significant move in the interest rate environment. And it'll be really interesting to see what happens to stocks if the 10-year treasury can get to 2% in yield, if that creates some headwind for stocks. But I'll talk a little bit about small caps and the move we've seen there, and then Josh can talk about emerging markets. Small caps have been a huge laggard relative to their large cap peers for quite some time now. We've always had them in our portfolios because we know over the very long term that small caps outperform large cap by about 2% per year, and over a lifetime that can have a meaningful impact on a portfolio. So small company stocks, they by their nature are growing quicker than large company stocks. And when we see a reflation trade and economic recovery, small caps tend to outperform by a pretty dramatic amount. And so really since September, the end of September, small caps have had a unbelievable, more than double the return we've seen in large cap. And over the last year, also more than double the return we've seen in large cap. And what that means now is that the 3-year number for small cap stocks, for small company stocks, now is beating large caps or the S&P 500. And so you can see, you never know when that tide is going to turn. We just knew that small caps were cheap relative to large caps. We don't, though, believe that it's over. We think that the move in small caps has some legs, and it's why we're continuing to own them in relatively high allocations in your portfolio. And so you can see the Vanguard Small Cap Value and the iShares Small Cap Index in your portfolios have done really, really well, really since September. But we think that's going to continue out into 2021 and probably 2022.
Emerging markets have also been a pretty outstanding outperformer relative to the large caps that are so often cited in the media. Looking back a year ago, emerging markets have actually doubled the performance of the S&P. To drag the chart out longer, emerging markets still have a long way to go to catch up for their pretty dramatic underperformance over time. As the dollar continues to weaken, expect emerging markets to continue to outperform. The emerging markets that we own are pretty heavily concentrated into China and Taiwan, specifically Taiwan semiconductor manufacturing in Taiwan represents a big chunk of exposure, but Chinese markets have been on an absolute tear, and emerging markets are poised to continue to outperform, specifically as commodities make up a pretty good segment of market caps there still. And similarly, their economies haven't really been shut down, and Chinese outperformance has been pretty dramatic. So expect that to continue.
We're also seeing outperformance in international developed markets and mid-cap stocks. And so diversification is certainly working and has to a big extent since September. We think this period will be similar to what we saw in the late 90s when we do eventually see this market correct. We think the part of the market that's going to be the worst off is large cap US growth stocks, a lot of the names that you know, and as long as you have a properly globally diversified portfolio, we think that is going to hold up well if we see a market correction. It's not. I'm not here to say that it's not going to go down. We just think it's going to go down less than U.S. large cap growth stocks, because if you remember, from 2000 to 02, the Nasdaq went down 82%. I don't know that that's going to happen again, but in a diversified portfolio over that same period of time, you actually made money, and we think that's why we're going to stay diversified. So as always, if you have questions about your situation or your accounts, call our office. That number is 800-743-0988, and we'll see you back here in 2 weeks.